recording. Ah, and here comes the coffee. Apparently, McDonald's works for Babalas, you know? Okay. Good morning. Let's start. It's good to see all of you, hypothetically. Yeah, like I said, this morning I'm sitting down and lecturing, so I feel as if I'm reading the news. But anyway, we'll get through this together this early on a Monday morning. Okay, so we're doing our last lecture for IAS 12. Oh, you also feel like that about IAS 12? Okay, our last lecture. However, tomorrow's lecture on IAS 16 isn't actually an IAS 16 lecture. It actually has more to do with IAS 12. So we will still be looking at deferred tax. And like I said, deferred tax should become your favorite topic, because you are going to see that in all of the other topics throughout the year. So make sure that you get that warm, fuzzy feeling about deferred tax. Good. So on Thursday we started with tax losses, and we just looked at a basic tax loss. What happens? How do we recognize a basic tax loss? So before we get there and we look at some more complicated tax losses, let's just quickly recap what it is that we are trying to do here. Okay, so usually when we have our current tax calculation, we start off with our accounting profit, then we make some adjustments and we calculate our taxable income. Okay, and this amount we multiply with 28%, and then this is our current tax expense. What this amount that I got after I multiplied with 28%, that's our current tax expense. So we do a journal there where we say debit the income tax expense in a P&L, and we credit the current tax payable. Okay, in SFP. Okay, so that's normally what we do. That's usually the journal that we do for current tax. If now, for example, we do our current tax calc, and let's say we had an accounting loss. So we start off with an accounting loss, and we have our adjustments, and that gives us a taxable, or a tax loss, not taxable loss, a tax loss. Now, what I told you in that first, I think it's the first video that you had to watch for IAS 12, I said that the worst thing that you can now do is to go and do a journal like this for me, to say, okay, now I've got a tax loss, so now I say credit income tax expense in profit or loss, and debit current tax, it should be a receivable because it's a debit. Can you see that this does not make sense? It does not make sense that you're doing to do this journal. Okay. However, many of you, although you don't do the journal, many of you, what you'll do, and I know, or what you are going to do, is in your income tax expense note, you are going to have a negative amount, an income amount for current tax for the year. And that is wrong. And in that first video, I told you that I'm not allowed to say that you will be struck by lightning when you do that, but there is a possibility that it's going to happen. So please don't do it this way. When we have our current tax calc, we don't create a current tax receivable, and we can't create a income tax income from this tax loss. However, we know that this tax loss is going to give us a tax benefit in future. We know that this leg of the journal is not necessarily wrong, because we are going to have a benefit in future, which resulted in this current year. So therefore, this leg of the journal is not necessarily wrong, but we're not allowed to put it to current tax receivable. We can't phone up the SARS and say, hey, you owe me money, I made a loss, pay me the money. We can't do that. So what we do, effectively what we do, is we actually create a deferred tax asset for this tax loss. Deferred tax in SFP. Okay, so effectively this is what happens. We don't always, remember we don't do our deferred tax journals per item, per line item, but this debit is going to decrease my deferred tax liability, or it's going to create a net deferred tax asset, but the effect is the same. The effect is that I'm saying, yes, I did actually have a benefit in this year, or I do have a benefit in this year because I've got this tax loss. But I can't phone up with the receiver and tell them, hey, pay me the money, but I can create a deferred tax asset for this amount. Okay, so that's effectively what happens with a tax loss. So we have this benefit that we are going to, because of the results in the past event was the loss that we made in the current year, but we are going to get the benefit only in future, and that's why we create this deferred tax asset. Okay, but now there should be some warning bells. What? Warning bells ringing. Okay, those are not wedding bells for the girls, these are warning bells, just to tell you, watch out, the moment we have a deferred tax asset, there are some limitations. Okay, that we should watch out for. Okay, so that's the basic, the starting point then of the purpose or what we do with tax losses. So in class example 12, the one that we did on Thursday, we had a basic tax loss, and there was no limitation on the recognition of the unused tax loss. So therefore, if we think back to our lecture on Thursday, when we looked at theory, we saw that in paragraph 36, we were told that if we, well, first of all, in paragraph 34 with a limitation, we were told that we can only recognize a deferred tax asset to the extent that we are going to get these future benefits. It's probable that we are going to get these future benefits from the deferred tax asset of the tax loss. And in paragraph 36, it just tells us how do we decide if it is probable or not. And what actually happened in class example 12 is we had the situation where the entity had sufficient taxable temporary differences to absorb this deferred tax asset, the debits, and therefore we could just go ahead and recognize the tax loss, unused tax loss. So what we did, here's our current tax calculation. Again, it's yellow. Oh, I see, you can't really see the yellow there. But this is important. This is just a calculation. This is just a calculation where these are my notes. Please do not, when I ask you for an income tax expense note, give me the current tax calculation. That's just a calc. Okay, so in example 12, we had an unused tax loss at the end of 20x2. Which we then utilized in 20x3. Now, in our deferred tax calc, we calculate how much of this unused tax loss in 20x2 we can actually recognize. And we see here that because we have, there's our unused tax loss that we are now putting in there as a deductible temporary difference. It is a temporary difference, but it's specifically an unused tax loss. And we have enough taxable temporary differences to absorb that unused tax loss. So therefore, we're still sitting with a net liability. So we do not have to worry. Paragraph 36 says, okay, go ahead, recognize these benefits. So therefore, in our income tax expense note, we've got the for current tax for 20x2, we've got a 0, and this is where the lightning is going to strike you if you put a negative amount over here. We'll never have an income amount for our current tax for the current year. However, like we discussed just now, we will recognize that income, but in the form of the movement in deferred tax. So the movement from a 2,800 opening balance to 1,540 closing balance. So there's my deferred tax. we had a liability opening balance of 2,800. Now we say, okay, but we want a closing balance of 1,540 liability. So that means we need an amount here. We have to do a journal here to fix that closing balance, and that journal will be for 1,260, and the other leg goes to my income tax expense, 1,260. So there's my my income now, my tax income from this tax loss that we have. We're recognizing it through deferred tax. Good. And then our deferred tax note is just a summary of what this balance consists of. So we're saying this balance consists of, first of all, the differences between depreciation and wear and tear, accelerated wear and tear for tax purposes, or you can also say accelerated depreciation, because it's just a difference between wear and tear and depreciation. The temporary differences there, as well as the 2,660 from my unused tax loss. Okay, so that's example 12. Can we move on to some more difficult examples, or have you got a question before we carry on? Any questions? 5, 4, 3, 2, 1. Okay, good. Crunchy and cream soda. That sounds good. Please repeat the 1,260 account. Good. I can do that. Okay, because that is a very important principle. Let's try and do it neatly. I wanted to go study to be a teacher after matric, but I realized that my handwriting is too bad. I will never be able to write properly on a blackboard. And apparently they've got a subject called blackboard writing or something like that. So they get graded for how well they write on a blackboard. So I would have failed that. So I went for second prize and I became a chartered accountant. Good. So we have these two T accounts. This is my deferred tax SFP account, and this is my income tax expense P&L account. So the opening balance for 20X2, the opening balance on the deferred tax account was a liability balance of 2,800. Now we do our deferred tax calc at the end of the year, and we see that we now have a deferred tax closing balance of 1,540. Okay, so we have this. We want this to be our closing balance at the end of X2. So therefore, we want this 1,540 to be our opening balance then for the next year. So this is our closing balance, brought down and brought over, and I can't remember the terminology. But now to make this, to balance out this account, we need something here. We need an entry over here. And the entry that we need is the 1,260 to get to the 2,800. 5, 6, 7, 8, yes. Okay, so the other leg of that journal goes to my income tax expense. So now it's a credit amount. Remember, an expense will always be a debit total. However, we're now putting a credit to that expense account, and that's why we have this negative amount in our note here. So we have this negative amount, 1,260 income in our income tax expense account and the income tax expense note. Okay. How would you explain the movement in the unused tax loss from, unused tax loss from temporary difference, no. But 20X1, our temporary differences weren't 0. We had 10,000 temporary difference. That's our opening balance for X2. Oh, okay. I see what you mean. Okay. So the question that Ms. Swanepoel is asking over there is, okay, let me just clean everything. Okay, so she's saying, and that's a good point. So she's saying that there's actually in this deferred tax movement, there's a movement just related to the accelerated wear and tear or the plant and machinery from 10,000 to 15,000. Okay, so this movement, so the movement from 2,800 to 4,200. So effectively what happens, let's just get another color there. So effectively what happens is this 1260 over here, this 1260 in my income tax expense, actually consists of, if we had to do our deferred tax calc and the move, or not deferred tax calc, but our GL entries or general journal entries per item in our deferred tax calc, then what we would have had is we would have had a movement from 2,800 liability to 4,200 liability. So we would have had an increase in the liability. Let me just clear this as well. So we would have had an increase in the liability of what's the difference? 1,400. So our liability would have increased with 1,400 from this movement from 2,800 to 4,200. Okay. Then we have this movement. We have the movement from 0 tax loss in the prior year to 9,500 in the current year. And so a movement from 0 deferred tax to a 2660 debit. So that would be then the 2660 debit over here. So these two together, the net of these two movements in deferred tax give us the net movement of 1260 over here. Okay, so we don't do it this way. We don't do it per item in my deferred tax calc. We just look at the net movement, and you see. But you see, the 1260 consists of these two movements in our deferred tax. Okay. Yes. Isn't that only used for calculation purposes and not recognized? Yeah, but remember, in example 12, we could recognize it. Because remember, we are allowed to recognize it if we have sufficient taxable temporary differences, which is the case over here, because we have our taxable temporary differences. So that's enough to absorb my tax loss. Therefore, I'm sitting with a net deferred tax liability. So we could recognize it all. Okay. Okay. And you always recognize the unused tax loss if there are sufficient deferred tax liabilities, and when there aren't, that's when you look at the points in paragraph 36. Well, paragraph 36, the first point over here tells us that when there's sufficient taxable temporary differences, then don't worry about it. Go ahead, recognize the full unused tax loss. Okay, so we'll see now in the next examples, we'll look at points B, C, and D, and whatever, and also when they don't apply. But for now, class example 12, we can stop after point A in paragraph 36. Good. There was no tax loss in 20x1, no movement, you created a tax loss. Yes. Yeah, so last year in 20x1, so I deleted that just to make space on my slides, but in 20x1, that was just a normal current tax calc. There weren't any tax losses or anything. So therefore, there was nothing to put into my deferred tax calc for 20x1 regarding tax losses, because we didn't have a tax loss. Now at the end of X2, we have an unused tax loss. It has not been used yet. Okay, we couldn't use it, but it originated in 20X2, and we can only use it in future, so it's an unused tax loss. So that's why we put it in our deferred tax calc for X2. Now in the next, and in X2, what we are also doing over here is we are recognizing the full unused tax loss. Okay, so there's no unrecognized portion, but it is still unused. In 20x3, we now use it. We've now used it completely. Therefore, there's nothing to put into my 20x3 deferred tax calc at the end of 20x3, because we don't have an unused tax loss anymore that we can put into that calc. Okay, let's see. What else did I miss? Will you be marked wrong if you do it per item? Do it per item, not yes, that will be silly. Hello. sorry, I didn't mean to be disrespectful. So it's a very good question, Mr. Groenewald. I can see that you're very clever to think of this way. Anyway, but it will be silly to do that because remember, a normal, even a small business, our deferred tax calc is not going to look like this. You're going to have many items in that deferred tax calc. So, and also in even in a question and test or exam, we're not going to just have one asset. There's going to be an allowance for expected credit loss. There's going to be income received in advance. There's going to be prepayments. So yeah, we don't do it per entry. That's just, it's going to take you too much time, and we don't do it that way. Okay, and it's impracticable to do it that way. Okay. All good, okay, thank you. Because you are going to have to do a evaluation for me later on, and then there's a question that says, does the lecturer treat the students with respect? And I suppose if you want to, you can nail me there. But anyway, good. The last post was the question, where we move from plant and machinery in 20x1 to 20x2, there's a 5,000 rand temporary difference increase. Yes. Which means in the future we will tax on this amount. Currently in the Splokkie we are receiving a deduction of 5,000. Now I want to know the aforementioned in respect of the tax loss. Okay, but I'm not sure if I understand your question, because here in our current tax calc, I think I do. I think I understand what your question is. So remember that we said that this 1260 over here actually consists of a positive 1,400 and the negative 2,660. Okay, so that's what this 1,260 consists of. So the decrease that I'm going, here's my decrease of 5,000 from my temporary differences in the 20x2. So that decreases my current tax for 20x2. But because it's temporary differences with deferred tax, we go and we say, okay, but this is just because of timing, so therefore we don't want to show that benefit now, so therefore we increase it again. And that's what we do with this 1,400 over there. So this 1,400 is now to cancel out the benefit that I'm getting from my temporary difference in X2. Okay, so the 2,660 is now this amount that I'm going to use in future. So we've cancelled out the 5,000 benefit because that's just a temporary difference, and the 9,500 we're saying, well, that's going to give us a benefit in future. Okay, so I think that if I'm still not answering your question, then you can pop me an email. I'll see. Is it best practice to have your tax loss as your last item? Yes, yes. Okay, so what you'll see, what you have to do in a test or an exam, you are going to actually do your deferred tax completely, and then you are going to calculate a subtotal. Okay, so you are going to have all your items over there, calculate a subtotal, and then only you put your unused tax loss in. Yeah, so that is what you are going to do. You're correct. Good. I'll ask more details via email. Okay, great. Good. Are we not supposed to evaluate all tax assets to see if there are sufficient tax liabilities before we can recognize it? Yes, okay, but I think that's the same question that Swanepoel had at the top. So we are going to have all our items over there, all our assets and liabilities and prepayments and paid in advance amounts, income received in advance, all those things, and then we are going to calculate the subtotal, and then we put in the tax loss. Okay, so I think I've got all those questions on example 12, so now we can move on to the next class example. Okay, so class example 13. So what happens in class example 13? It's the same information as class example 12, but no, it's not the same information. Sorry, it's a little bit different. And again, there's no limitation on the recognition of the unused tax loss. No limitation. But we now have a net deferred tax asset. So what that means is we will not have sufficient taxable temporary differences, because remember, if we did have sufficient taxable temporary differences, that means that we would have still had a net credit balance on deferred tax. So in this example, paragraph 36, we don't comply with that. So remember, we're now trying to determine whether we can recognize a deferred tax asset or not. So we don't comply with 36A. So now we have to check whether we comply with B, C, and D. So B says it must be probable that there will be taxable profits in future. Also, this tax loss must have resulted from identifiable causes, unlikely to recur. And also, if there are tax planning opportunities. So these three things together must give me a warm, fuzzy feeling to tell me, yes, it's fine. We can go ahead and recognize a deferred tax asset. So let's see. In class example 13, well, they tell me there in the required section, they tell us in part A, assuming that there is sufficient future taxable profit to recognize a deferred tax asset. Then they ask us, go and calculate the tax expense and the notes and all of that. So can you see that this information that they give us in the question, that there will be sufficient future taxable profits, that tells us, okay, so we meet this requirement. And obviously, if we are going to make profits in future, then the reason why we had these tax losses will not, or unlikely to happen again, because we are going to make taxable profits in the future. So therefore, now we can recognize that net deferred tax asset. Good. So if we look at class example 13, then we see the following. Ooh, lekker. So now we see that in our current tax calc, again, remember this is just a calculation. In our current tax calc, we now again end up with an unused tax loss. Good. So we did all our, we started here with a loss, and we did our adjustments, and we end up with a tax loss. So that means that there will be zero current tax for 20X2. And that's also why in our income tax expense note, we have this zero for current tax for the current year. Current tax, current year. That's what that means. Good. However, now at the end of X2, we now do put in all our assets and liabilities and thingies, and we calculate a subtotal, and we see that our subtotal over here is a deferred tax liability of 4,200 Rand. Now we put in our tax loss, and now we see that if we put in our tax loss like exactly as it is, or we put in the full, we recognize the full tax loss, we are going to end up with a net debit balance on our deferred tax account. So now, warning bells going off, ding, 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 watch out. If you want to recognize an asset, you have to go and look at paragraph 36 first. And we've now looked at paragraph 36 and we've said, okay, it's fine. We can recognize that net deferred tax asset. Okay, so we can recognize the full unused tax loss, even though it creates the net deferred tax asset for us. Good. So then now we go and we do our journals. So here's my deferred tax SFP account and my income tax expense P&L account. Our opening balance at the beginning of the year was a liability of 2,800. Now we want a debit closing balance. So that means at the beginning of the next year, we want a debit opening balance. So that's the balance brought down. That means we've got the 1120 balance carried forward, carried down, can't remember. Okay, so we need something on this side of the journal or this side of the general ledger account to balance the account. Okay, and the movement therefore that we need, the amount that we need is 3920. And the other leg of that journal goes to my income tax expense, 3920 as a credit. And there's my 3920 income on my income tax expense. Okay, so because we could recognize the full unused tax loss, we've got that income sitting over there. Good, yes. Then in our next year, what happens? So in the next year, we do have a current tax expense of 60. And now our movement from the debit balance to a credit closing balance. Remember, now we don't have the tax loss in here anymore, because at the end of 20x3, we have, I'm just checking, I did record. Yeah, I did record. At the end of 20x3, we don't have an unused tax loss anymore because we've used the full unused tax loss amount. We've utilized the full amount. So therefore, there's nothing for my unused tax loss for 20x3. So now the movement from a debit balance 1120 to a credit balance 5,600 will be the 6720 in 20x3. Good. Now, have a look at the reconciliation for this example. So you will now see that if we take our accounting profit, the accounting profit that we had over here, for 20x2. If we take that accounting profit and we multiply that with 28%, then, so there's our 14,000 accounting profit. If we multiply that with 28%, we get 3920 as my income tax income, which we're not allowed to recognize that for current tax, but we're allowed to do that with deferred tax. And because we could recognize the full tax loss, unused tax loss, we don't have any reconciling items. That is the total of my income tax expense for the year. Okay. Okay. So just one point on this before we before I answer your question, Ms. Lewis. Hope I'm pronouncing that right. Probably not. Just a question on exam technique. If you're doing a reconciliation, you are going to get a balletjie. You're going to get a mark-through mark or a bonus mark just for showing that this amount should be the same as this amount. Okay, so when you do your reconciliation, you take your accounting profit, multiply by 28%, put it in here, but then you show that you know that your reconciliation, you should be reconciling to this total. And that is, you are going to get a mark for that. Okay, so even if you do put in reconciling items and it does not add up to that total, doesn't matter. I want to see that you at least know that the total of this reconciliation should agree to your total income tax expense. Okay, so remember that for tests and, I pronounced it right. Okay, cool. Good, there was a question, where does the 19,000 utilization of the unused tax loss in 20x3 come from? Never mind. Okay, cool. Do you also see whether you can use the full tax loss for the current tax calculation? Okay, Mr. Armstrong, you are just jumping the gun a little bit. We are going to look at what happens if we couldn't utilize the full tax loss in the next year. Okay, that comes in the next examples. Okay, so that's then, so as you can see up to now, no problem. We can go ahead, recognize the full tax loss, no issues, quite straightforward. Okay, now things become a little bit more interesting. Class example 14, because what happens in class example 14, now we have limited recognition. So now in this class example, you'll see that we do not have sufficient taxable temporary differences. We do not know we do not think that it's going to be probable that we will have taxable profits in the future. And we also do not have tax planning opportunities. So paragraph 36 in this case doesn't, or we see now that here we have a problem that we cannot recognize a deferred tax asset. Good. So that's what happens in class example 14. We have this limited recognition. Okay, and if we look at class example 14, we see that for this example, they tell us we have to assume that there is no certainty of sufficient future taxable profits. So we are not sure whether we are going to be able to use this benefit. Okay, so remember that the moment we have an asset on our SFP, we are saying that we promise that this is going to give us value in the future. So therefore, the only way we can get value in the future from a tax loss is if we make profits against which we can use the tax loss to pay less tax. So if we're not going to make profits in the future, we cannot recognize that asset. And that's what happens here in class example 14. Good. Okay, so, well, okay, don't look at this now. Don't look at, never mind. So just let's look at the current tax calc first. So we see that in 20x2, the amounts are now the same as class example 13. So in 20x2, we had our unused tax loss of 19,000, and we are using it, utilizing in 20x3 to pay less tax. Exactly the same as what we had for in our previous example. But now in our previous example, so this deferred tax calc that I have over here is actually example 13's deferred tax calc, where we were able to recognize the full unused tax loss. So in example 13, we had our tax loss over there, and we were able to recognize the full amount, and that gave us a deferred tax asset of 1120. Okay. Now what happens in this example, in class example 14, is, sorry, just a little bit of, my screen is just freezing a little bit. I will so long take a sip of coffee. See if I can fix it. There we go. Okay, so now I'm showing you this. So this was class example 13's, the yellow block there is class example 13's deferred tax calc. Now this is what the class example 14's deferred tax calc looks like. So you see, we still have our unused tax loss there of 19,000 Rand. But if we now multiply that with 28%, we get the 5320. Which would have given us the 1120 debit deferred tax asset, but now we're not allowed to recognize the asset, so therefore we have to limit it to 0. Okay, so we have this limitation. Okay, you can see that this calc does not work out because we had to limit it to 0. Okay, we could not show that negative amount for deferred tax. Okay. So what happens now is, if we now do our deferred tax journals, so there's our deferred tax SFP account and my income tax expense account in P&L. We had an opening balance of 2,800 liability. We want a closing balance of 0. Okay. So therefore, what do we need in this account? We need a debit here of 2,800 to get to the 0 closing balance, and the other leg goes to the income tax expense. Okay, so there's our 2,800 credit in our income tax expense. That goes to our income tax expense note. So we've got a 0 for current tax because we did not have any current tax. But we have this movement, the 2,800 movement. So can you see that we now, in our previous example, if we go back to class example 13, we had, we had movement there. Come on. It seems like my I have the same problem. Never mind. We had movement there of 3920 because we were able to recognize the full. We were able to recognize the full unused tax loss, so we had our movement of 3920. Now, in class example 14, we only have the movement of 2,800. Okay, can you see that? So we have limited recognition. Okay, so remember the wording. So here we had, in our current tax calc, we had an unused tax loss. Now in our deferred tax calc, we have an unrecognized tax loss. Okay, a proportion of my tax loss is unrecognized. And that portion of the tax loss, tip of the pen is screwed in tight. Thank you. So that portion of the tax loss that is unrecognized now causes problems for us in our reconciliation. Okay, in our tax rate reconciliation, this now causes problems for us. Because we were now not able to recognize that full amount. So therefore, if we now take our accounting profit, the 14,000 accounting profit, and we multiply that by 28%, we get to an amount of 3920 income for my income tax expense. Okay, which in class example 13 was exactly the amount that we had here in our income tax expense, the total we had over there. However, now we only have 2,800. So the difference between the 3920 and the 2,800, remember that 2,800 always has to be the same as the total of your income tax expense note. The reason why we have this difference is because of the 1120 portion that we could not recognize. Okay, so you'll see the difference between the 4,200 and the 5,320 is the 1120 that we could not recognize. So that's why that is then a reconciling item in our reconciliation. Okay. Now next year, what happens in the next year is now we are able to utilize the full tax loss. So remember that the fact that we could not recognize everything does not take away from the fact that we still had the full 19,000 tax loss. The receiver of revenue does not worry about what did you recognize and what didn't you recognize in deferred tax. The receiver of revenue does not see. Okay, see, that's the receiver of revenue's eyes. SARS does not see the deferred tax calc. It's closed. SARS does not see the deferred tax calc. SARS only sees this calc. Okay, so SARS only sees this calc. So SARS knows you had a loss in the previous year that you can utilize the full amount in the current year. So therefore, now in our current year, in 20x3, our current tax was decreased with our the full tax loss. The full tax loss decreased our current tax expense. This amount would have been higher if we did not have that tax loss. Okay, but remember now the movement in deferred tax, this movement in deferred tax only shows a portion. So from the 0 to the 5,600, that includes only a portion of that actual tax loss that now reversed in the 20x3 year. Okay, so this movement in deferred tax, first of all, relate to movement from 4,200 to 5,600. So that movement, this 2,800 movement over there, actually consists of 1,400 liability, or increases my deferred tax liability, and then there's 4,200 debit amount from my tax loss. Okay, so the movement from the, remember this is from the 4,200, that's the recognized portion, to 0 is this 4,200 movement. Okay, because remember we could not recognize the full 5,320. We had to recognize 4,200 in order to get this to 0. Okay, so therefore this movement of 4,200 in my next financial year is smaller than what it would have been if I were able to recognize, if I were able to recognize the full tax loss in the prior year. So that's why in our next financial year, if we start with our accounting profit of 26,000, for 20x3, we multiply that by 28%, and it gives us 7280. That does not agree to my total in my current tax calc of income tax expense note of 6160. And the reason for that is because of this movement of 5,600. That amount would have been bigger if I were able to recognize if my full tax loss was included in our opening balance of the next financial year. Okay, so if we look at, if we now look at, let's try and erase something again. Yes, now it works. Thank you. Screwing in the tip worked. If we now look at this movement we have over here, the 5,600 movement we have in our 20x3 year, and we can go and compare that to the movement that we had in class example 13, where we were able to recognize the full amount. And you see that that movement is now smaller for this is example 13, where we could recognize the full amount. It was 6720. Now in example 14, the movement, this is example 14, the movement is only 5,600. Okay, so that reason for that difference is because of this, the opening balance of deferred tax that did not contain the full recognized tax loss. Okay, let's see. Okay, let's quickly stop there and check if there are any questions. So what time do I have? 8, 9, 9:30. Yes, cool. Thanks. Okay, should the 1,400 credit to the deferred tax GL account not be a debit to make the 5,600? Okay, let us. So what you are saying, Mr. van Buren, it's very probable that I sometimes do get my journals wrong way around. I'm not very good with numbers. Okay, so what we are saying, so this is our deferred tax SFP account, and this is my income tax expense account in the P&L. Okay, so we have the movement, 1,400 credit to the deferred tax GL. Are talking about the movement from the 4,200 to the 5,600. Is that what you're talking about, Mr. van Buren? Yes, cool. Okay, so so our opening balance for deferred tax now, so now we're looking at 20x3. We're looking at the 20x3 year. So our opening balance there would have been 0. Now this 0 opening balance actually consists of a 4,200 liability because from my plant and machinery, I'll just say PPE to make it shorter. And it consists of a 4,200 debit from my tax loss. And that's this is what gives us the opening balance of 0. Okay. So now what happens in 20x3? Yes, so we are now looking at the movement to the 5,600, from the 0 to the 5,600. So that's what my opening balance consists of. Now my closing balance, we want our closing balance, no, sorry, let me just give me myself more space. We want our closing balance now to be, we want our closing balance to be 5,600 liability, so 5,600 over there. So this closing balance of 5,600 now will consist of the tax loss of 0 and the 5,600 from PPE. Okay, so that's at the end of 20x3. So the movement from the 4,200 liability to the 5,600 liability would have given us, so we would have had to credit the deferred tax account with that 1,400, and the other leg would be here in our income tax expense. But the movement from the 4,200 asset to the 0 would have given us then a movement of, we would have had to, I'm confusing myself now. Debit, so it's a credit. Yeah, so it's we needed the credit over here of 4,200 as well, so that would have given me the 4,200 over there, and together these two make up the 5,600. Okay, so question, should the 1,400 credit, so that's the 1,400 credit. I know I have got such bad handwriting. I know. I'm sorry about that. Please send an email to the HOD. So this 4,000, we said that we needed the 1,400 movement and the 4,200 for the tax loss. Okay, so you are saying the 1,400 credit to the deferred tax account. So you are referring to this 1,400 credit to the deferred tax account. It should not be a debit to make the 5,600. No, because I'm increasing my liability. Our liability opening balance was 4,200. Liability closing balance is 5,600. So we increase the liability. So therefore, it should be a credit. Okay. Cool, Mr. van Buren. Okay, but remember, we don't do it this way. I'm just showing you what that movement consists of. We actually just do a journal for the movement. So we would have just said, okay, our opening balance was 0. We want our closing balance to be 5,600. Therefore, we need a movement of 5,600 over here. That goes to my income tax expense account. Okay, any further questions on the limited recognition of an unused tax loss? Okay, don't know if you're still typing. I wish it could show me whether someone's typing or not. Good. Okay, so we can carry on then. Just on this bad handwriting, I remember, I'm not sure if it still works that way, but when I was in standard 1, so that's grade 3, grade 1 and 2 you write with a pencil. And then when you get to grade 3, then if your handwriting was neat enough, then you got a pen. And I loved my standard 1 teacher, and I was working so hard. I desperately wanted to get a pen. And every day, all of my friends, every day someone would get a pen to start writing with a pen because their handwriting was neat enough. And I was just really hoping that I would get the pen, and then trying very hard. And then one day the teacher said to me, oh, okay, your handwriting is now neat enough for a pen, so I'll give you a pen. And I got so excited, and then she said, oh, let's just give pens to everybody in the class. So I was very disappointed about that. Yes, so throwback, I have a very bad handwriting. I apologize. Okay, but you can't be pretty and have a good handwriting. Okay. Good. Okay, so there was a question. Yes. Okay, there was SARS doesn't recognize the portion of tax loss that we couldn't use, therefore no tax base. Okay, so I suppose you're referring to the tax base, the 0 tax base over here. Okay, so there will not be a tax base because we have used the there we go. We have used the full 19,000 tax loss. So therefore, at the end of 20x3, there's no tax loss anymore. Okay, so there's nothing to carry forward to the next year. That's why our tax base in 20x3 is 0. Okay, no future deductions that we are going to get. Okay, so there was a question. Sorry, why does the unrecognized tax loss not go in the deferred tax calculation? Okay, Ms. McNamara, I hope I answered your question there. So, because at the end of X3, it doesn't exist anymore. It was used in X3 to make our current tax expense lower. Therefore, at the end of X3 does not exist anymore. So at the end of X3, we only look at what are our assets and liabilities at year end, and also what other benefit or tax future deductions are we going to get that does not have a carrying amount, but that does have a tax base. Good. Okay. Okay, cool. I'm glad I answered you. Okay, I wanted to show you something here. Oh yeah, that's just the difference now between the two reconciliations. So the reconciliation for example 13 and 14, but we did discuss that. Good. Okay. And next, class example 15. So what now happens in class example 15 is now we have unused tax losses in both years. Okay, so unused tax loss in both years, and there's no limitation. So no worries, don't worry, go ahead and recognize the full tax loss. Okay, so that means, so we'll see in class example 15, if we look at the numbers over there, if we look at our current tax calc, first of all, we now see that we have tax losses for both years, for 20X2 and for 20X3, we have tax losses. Okay, now when we do our deferred tax calc now for 20X2, we say, okay, our unused tax loss is 9,500 at the end of X2. We put that into our deferred tax calc. In this case, we paragraph 36A applies, so we have enough taxable temporary differences to absorb the tax loss, the tax benefit from the tax loss. So we're still sitting with a net credit balance. So go ahead, recognize it, don't worry about it. Okay, and therefore now we do the movement from the 2,800 to the 1,540. The liability now gets smaller, so therefore we are going to have to debit the deferred tax SFP account, and we credit our income tax expense with the 1,260, which is now the difference between the 2,800 and the 1,540. Zero current tax, because we are not paying any current tax, but the movement, the current tax or the tax loss is recognized in deferred tax. Good. But watch now what happens in 20X3. So in 20X3, we have this unused tax loss from 20X2, which we now, we put into 20, so in 20X3 we made some profits. So now we're using the tax loss from the prior year to now, to not have to pay tax on the 7,000 Rand. So luckily, we don't have to pay tax on the 7,000 taxable income for the year, because we still have this tax loss from the prior year. However, now this tax loss is bigger than the taxable profit that we had, taxable income. So at the end of 20X3, there's still 2,500 left of my unused tax loss. Okay, so in my 20X3 deferred tax calc, we have our plant and machinery and all our other items, but then we still have an unused tax loss of 2,500 remaining that is going to give us a benefit in 20X4. Okay, so that's now why we have a portion of that is still unused. So that's my unused tax loss, the 2,500 that goes into my deferred tax calc. Good. So again, we don't have to worry about limitation, because the taxable temporary differences are enough to absorb the unused tax loss, tax benefit. Therefore, we're still sitting with a net credit balance. Okay, so again, the movement from the 1,540 to the 4,920, so now the deferred tax liability increases, so we are going to have to credit deferred tax liability and debit the income tax expense with a 3,360, which is the difference between the 1,540 and the 4,900. You want me to do the T accounts? Or are you comfortable with that? Oh, let's do the T account. We've got time. Okay. So deferred tax, SFP. I love myself some T accounts. If you can do the T accounts for all topics, then you understand the work. Okay. So income tax, expense, and P&L. So we started off in at the end of 20X1. We started off with a 2,800 liability amount. Then for 20X2, we said, no, we want that liability to be 1540. 1540. We need something here to make this account balance, and the amount that we need is 1260. Ooh. See, if Ronel would have been upset with that handwriting. And then 1260 credit to income tax expense. There's my 1260 credit. Then in the next year, we are now saying, okay, now our closing balance should be 4,900. Okay, so what do we need? Now we need a credit. And the credit that we need is then 3360. So that in the next year now goes to the debit side, 3360. That is the 3360. Okay, cool. So that's class example 15, which means we are now getting to the last class example for IAS 12. Aww. Show me some. Aww. You also feeling that? You also love okay, W. I don't know what the W means, Mr. van Buren. But do you feel that love for IAS 12 that I have? Okay, good. No, Mr. Tsetsi, you shouldn't be laughing, you should be crying. Yes, like Mr. Dupree, he's crying because IAS 12 is now almost finished. Anyway, enough nonsense. No, can't promise that it's enough nonsense. There will probably be some more before the end of the lecture, but let's carry on. So what now happens in class example 16 is we still have, yes, but the lecture's finished, Mr. Duplessis. So that's the fun part. Anyway, so class example 16, we still have unused tax loss in both of the years. However, now in year 1, we have limited recognition, and in year 2, we have full recognition. So what happens here is that, first of all, we are going to have a deferred tax liability, or a deferred tax asset at the end of both years. So that means that Part A does not apply, because remember Part A says there's sufficient taxable temporary differences, which means that I have a net credit balance. And in this case, you'll see that I don't. I actually have a net debit balance. And then what happens is that in year 1, this does not apply. It's not probable that we will have taxable profits in future. So therefore, we have limited recognition. So in X1, we limit the recognition. But then in X2, we realize, oh, no, it's not that bad. We can actually go ahead and do it. So in X2, we have full recognition. Okay, so that's what happens here in class example 16. So if we look at the information, for class example 16, it tells us that taking the following assumptions into account, that for 20X2, there's no certainty about sufficient future taxable profits, but in 20X3, circumstances change, so there is now certainty about sufficient taxable profits. So in 20X2, we are going to have our limitation, and 20X3, we are going to have our full recognition. Okay, so let's see what happens in class example 16. In our current tax calculation, we see that for X2, we have an unused tax loss of 37,000. Then in 20X3, what happens is we actually make a profit, but we don't make enough profit, or we can use the unused tax loss to decrease or not to have to pay any tax in 20X3, but we still have an unused tax loss at the end of X3. So in our deferred tax calc, we have our 37,000 tax loss, unused tax loss. And at the end of 20x3, we have our 30,000 unused tax loss, which we can now carry over to 20x4. Good. But in 20x2, we could not recognize the full amount, so we had to limit it to 0. So the recognition there was limited to 0. So therefore, we could not recognize that full unused tax loss, and like we know, that is going to give us problems in our reconciliation. Good. So if we now, so what happens here in 20x2? So for 20x2, you see that, yeah. There's my deferred tax and there's my income tax expense. So we had an opening balance of 2,800 liability, and now we say no, we want a closing balance of 0. So that means that we need a debit in our deferred tax GL account over there, and the credit goes to the income tax expense account. Okay, so therefore there's our 2,800 in my income tax expense. So this is the P&L note, and that is because we had 0 current tax. That's the only amount then in our income, total amount for income tax expense. Now when we do our reconciliation, we start with our accounting profit, the 32,000 loss, accounting loss. We multiply that by 28%, and we get to 8,960 income. However, the total that we have is 2,800 negative income. Okay, so we have to reconcile the 8,960 to the 2,800. And the reason why there's a difference is because of the fact that over here we could not recognize the full unused tax loss. So that 10,360 over there, the 10,360 that we have over here, we were able to recognize 4,200 of that. However, the remaining 6,160 was unrecognized. Okay, and the unrecognized portion is now what gives us problems here, because if we were able to recognize the full amount, then we would have had the 8,960 negative over there as my movement in temporary differences. Okay, but now we were not able to do that, and this is the unrecognized portion, therefore, that creates a reconciling item. Okay, so that's for 20x2. Now in 20x3, we are now sitting with an opening balance of 0 on deferred tax, opening balance 0. And we've now, in 20x3, remember we said, okay, no, don't worry about it, go ahead. Now we can recognize that deferred tax asset. So therefore we have a debit balance for deferred tax. So we want a movement from 0 to a debit balance of 2,800. 2,800. So therefore, we need the journal that we need is we need the 2,800 over there. Goes to my income tax expense on the credit side. So it's income tax expense income, which is exactly what we have over there. That's the total of my income tax expense. That's the amount that I have to reconcile to. But I start off with my accounting profit of 12,000 multiplied by 28% gives us 3,360. And now the weird thing is, okay, but if we were now able to recognize the full tax loss here in deferred tax, why would we now have reconciling items? And the reason why we have these reconciling items is because of the fact that our deferred tax opening balance that we started off with did not include the full recognition of the unused tax loss. Okay, so if it did, if we were able to go into to have our deferred tax liability over here, or deferred tax asset over here, if we're able to recognize the full amount over there, then our deferred tax would have had an opening balance, a debit opening balance, but now it doesn't. Okay, so what now happens is of that, this 37,000 unused tax loss that we had in 20X2, that 37,000 we have used in two ways. Okay. So that 37,000 unused tax loss that was should have been included in our opening balance. First of all, we used some of that. We used 7,000 of that to make our current tax zero. So of the 37,000, we used 7,000 of that to decrease my current tax expense. Because remember, if I did not have this unused tax loss from a prior year, we would have had an amount there of, I think it's 1960, if I remember correctly. Let me just quickly double check myself. 7,000 times 28%, yeah, 1960. So if we didn't have this unused tax loss from the prior year, we would have had to pay tax on the 7,000, and that would have given us a current tax for the current year expense of 1960. So, but now we don't. We have a zero. So we don't have that. We have a zero. So we used 7,000 of my 37,000 in order not to pay current tax. Okay. And remember that 1960 that I would have had over here would have increased my total income tax expense. So this amount would have been different if I still had that current tax expense for the current year. Okay. And then the remaining 30,000 that's left of my unused tax loss, we are now recognizing as a deferred tax asset. Okay. But of that 30,000, we have actually already recognized, what's the amount? So we have recognized 4,200. So of that 30,000 that is that's still unused at the end of X3, of that 30,000, good. We have actually already recognized 15,000 in X2. Okay, why do I say that? Okay, so if we look at it over here, what happened in X2, then you see that in order to get to this closing balance of zero for my deferred tax asset, we had taxable temporary differences of 15,000. So therefore, this 37,000, we've actually used, we couldn't recognize the full 37,000, so we actually only recognized 15,000 in order to get to the zero closing balance. So 15,000 has already been recognized in 20X2. That leaves us with 15,000 of this 30,000 unused tax loss that we are now actually recognizing for the first time in 20X3. Okay. So for our reconciling items, in our income tax expense note for 20X3, we start off with our accounting profit, multiply that by 28%, and we are reconciling to the 2,800 movement. But the reason why the reconciling items that we have, first of all, so it's actually this 6160 that was not recognized in the prior year. We have some of that was first of all used to reduce the current tax. So that 7,000 that we used to reduce my current tax in 20X3 was, first of all, that was the portion that was not, so we're taking it first from the unrecognized portion of my tax loss from the prior year. And then we're saying, okay, and the remaining amount, 4,200, is then what was used to decrease the deferred tax expense, to decrease the deferred tax movement in the current year. Okay. Let's just clean it up a bit so that I can show you another calculation to make sure that you get this. Okay, oops. Come on. Sorry, keep, play. There. Okay. So you'll see in your notes as well, you've got this additional calculation, a little blocky there that just shows you how we calculated, how we got to the 1960 and the 4,200. So there's the 1960 and the 4,200. So that's the tax amount. If we now look at what the gross amount is that this tax amount relates to, we see that the unrecognized portion of 6,160, so that's the unrecognized portion from the prior year. First of all, that is then the gross amount is 22,000. So that's we were only able to recognize 15,000 over here. So that means the 37,000 total unused tax loss at the end of X2, less the 15,000 that we did recognize, give us then 22,000 that was unrecognized at the end of 20X2. So that's, if we multiply that 22,000 with 28%, we get to the 6,160. Now in the current year, we are saying, okay, of that 22,000 that was unrecognized, we first of all used 7,000 to pay less tax in 20X3, or to pay no tax in 20X3. And that leaves us with 15,000 that we are now recognizing in 20X3. Okay, so there's the 7,000 that's used to decrease the current tax expense, and there's the 15,000 that we are now additionally recognizing that we could not recognize in the prior year. Okay, the tax on that is 4,200. Okay, so we're saying that the reason why we have this income tax income for 20X3 instead of a tax expense is because we first of all use the prior tax loss to decrease the current tax expense, and then also we are recognizing an additional portion. Okay, so we would not, if we were able to recognize the full unused tax loss in 20X2, we would not have reconciling items, because remember then we can recognize everything. But now the fact of the matter is, because this 7,000, we say that comes first from the unrecognized amount, that's 7,000. That's why it goes into the deferred tax calc. Or reconciliation, sorry, deferred tax, or income tax expense note reconciliation. Okay, then I see there are some questions, but before I get there, I just quickly want to point something else out to you. I want to show you, we have spoken about this before, and I've had some consultations about it as well. The rand amount of the reconciliation versus the percentage amount. I just want to show you how that works. So you'll see that the only difference between the two is that what we do with our percentage method is we have to always go and this amount that we have over here, we will divide that by my accounting profit to get to our percentage. So you'll see that the 19.25 actually consists of the 6,160. So this gives us 6,160 divided by 32,000. That gives us 90.25. So every amount over here, so the same calculation to get to this amount, you do, and then you divide it by 32,000. There's the 4,200, and in the current year now it will be 12,000, 2,800 divided by 12,000. Okay, so you'll see that's why I say if we don't force you to use the percentage method, then go and do the rand method, because the percentage method has this additional calculation for every line item that you have to do. And there's also additional disclosure that you have to do. So for example, you'll see here that now we have to tell users that an amount of 1960 benefit from a previously unrecognized tax loss was used to reduce the current tax expense. So now we have to tell users this percentage. We have to tell them what the actual rand value was. Wherefore, if we do the rand format of the reconciliation, they can already see the rand value, so we don't have to tell them anything. Okay, and again, 4,200, we have to give the amount, but here in this recon, we actually do give the amount. First of all, or that's what we give, so you don't have to again have a sentence to say the amount was 4,200. Good. Okay, let's see. Let's look at some questions. Have you heard of companies that purposely calculate an incorrect fraudulent deferred tax balance in order to enhance the financial statements to attract investment? Okay, so I suppose you are now referring to maybe that they want to create a deferred tax asset in order to make the financial statement, the financial position look better. The problem is that your deferred tax balance is linked to your asset and liability values. So I don't think they will purposefully try and manipulate financial statements through deferred tax. Because like I said, then they actually will have to manipulate the asset values as well. So in fact, they will rather go and manipulate the asset values, and then the deferred tax balance is just the net product or the, yeah. So I haven't heard of that. Although, remember, when it comes to tax, yeah, what might happen is when you do your, when a transaction is so complicated that it's not that clear cut exactly what the tax treatment should be, then obviously companies might decide to show the most beneficial tax approach in their financial statements. So that way they will manipulate, they can manipulate their tax income and their deferred tax balance as well. But if the receiver does not agree, then obviously that's going to swing around in future. Okay, so yeah, so Mr. Duplessis says if they are listed, they will be audited. So I don't think so because it's easy to get caught because it just calcs. Maybe I don't know. Also ask these for tax increase, decrease income tax, but not increase, decrease, maybe not. Yeah, okay, so Mr. Duplessis, that's very true what you are saying. But like I said, sometimes with complex transactions, your auditors will obviously, when something is it's blatant that they are manipulating the numbers, then they will obviously pick it up. But sometimes you have transactions and complications, transactions between companies and all that, which is not that clear cut what the correct tax treatment should be. So if you can convince your auditors that this is the correct tax treatment, and then obviously you also have to convince the receiver of revenue, then you can obviously go for the most advantageous position. Okay. Okay. So yes, they will try and manipulate their tax expense, but not which I suppose they can do through deferred tax. But remember, your deferred tax is actually dependent on your asset and liability values. So then they will have to manipulate that. Okay, so Mr. Palafalo, in a scenario where we still could not recognize deferred tax for this year, there would have been a debit tax movement of 0 and no deferred tax at all. Correct. So if we go back to this situation, if this balance over here, we were still not able to recognize that deferred tax asset, then what's going to happen is we would have had a net 0 movement for my movement in temporary differences, and that would have been 0. Okay, and then okay, this amount over here would have been 0, which means we would have had we would still have this balancing amount because that is the 7,000 that we now use to decrease our tax expense in X3. But the additional portion that I'm now recognizing, because now I can recognize an additional amount because my taxable temporary differences are higher, the liability amount. So that would have been the difference. I think it would have been 1,400. Let's see if I am correct. I know I am, but we'll just check. Yes, cool. Okay. Mr. Herter, will the 6160 of X2 always equal the X3 current tax expense plus the deferred tax expense in a scenario like this. So the 6160, well, the 6160 of X will always equal the X3 current tax expense. Okay, you mean the 7,000 over here. And the deferred tax. Okay, but remember when we're doing X2, when we're doing our X2 amounts, we won't know yet what our X3 amounts are going to be. Okay, so we won't know yet what our X3 amounts are going to be. So the X2, the 6160, where this 6160 comes from, it comes purely from the fact that the portion of that 37,000 that we could not recognize. So it comes from the 37 minus the 15 taxable temporary differences, gives us the 22,000 that we could not recognize. That 22,000 times 28% gives us the 6160. So in 20X2, we would not yet know what our current tax expense for X3 is going to be. Okay. Okay, can you please explain the 4,200 amount in the recon again? Yes, I can. Come on. Oh, now I realize what happens. But anyway, good. So the 4,200 in the recon, what that amount is that, remember now, in 20X2, as we said, we had the 37,000 unused tax loss, but we could only recognize 15,000 of that in order to get to a zero balance. So we could only have a minus 15,000 actually in there. So the difference then, the unrecognized bit of the 37,000 less the 15,000 that we could recognize gives us 22,000 that was unrecognized. Good. Now that unrecognized, so when we get to 20X3, we have that unrecognized portion at the beginning of the year, of which we use 7,000 to decrease my income tax expense for 20X3. And then we are able to recognize the remaining, what was it, 15,000. Yeah. We are able to recognize the remaining 15,000 of that loss. So that 15,000 times 28% is the 4,200 movement that I am now able to recognize. Okay, so that's the 15,000 additional tax loss that I could now recognize, and that's the 28% on that. Okay, so because remember, if we were able to recognize the full amount, then this movement would have been different, because now this movement is a movement from 0 to 2,800 asset. But if we were able to recognize the full amount last year, this movement would have been different. So this amount would have been different, and we would get to the 3,360. But the reason why this amount is not 3,360 is because of, first of all, don't have any current tax, and second of all, there's an additional portion that I'm recognizing. It was not recognized last year, because your reconciliation, you must remember, your reconciliation is period specific. So in our reconciliation, we start with a period specific accounting profit for that year. So the moment we have things in here that relate to prior years, then it's going to end up in our reconciliation, unless we were able to account for that, recognize it through deferred tax in the prior year. Good. Previously unrecognized. Another way to think about it is the 6160 amount previously unrecognized but now fully recognized minus the 1960 portion of the 6160 used to reduce it. Yes, exactly. That's what this calc shows us over here. Can you explain the 1,400 amount included in the reconciliation again? The 1,400. Which 1,400? Okay. Okay, we'll get to that. The 1,000 in the recon that we got when we had a limit for both years. Okay, so that's in the previous example. No. Oh, I can't remember now where that is. Oh, okay, so the 1,400, the movement from the 4,200 to the 5,600. Okay, I'm not exactly sure, Mr. De Jager. Yeah, let's see if I don't answer your question, if I maybe answer your question when we talk through the others. Otherwise, please send me an email. Okay, Mrs. Swanepoel, in the recon X2 is the 6160 positive. Where's we go? 6160 positive. Because should it have been recognized deferred tax calc, the movement would have been 8960, yes. Instead of 2000, thus technically we are decreasing our income tax expense with less. If we do not recognize, we show this by showing the 6160 as a positive increase. Yes, so we actually, our movement would have been, we would have had a bigger movement to a bigger debit balance, or to a debit balance. So that movement would have been bigger. Now it's not that big, so it's actually, so the debit is now not there. That means the credit in my income tax, expense is now smaller than what it would have been, and the reason for that is that unrecognized bit. Okay. Student asked about not one of the examples. So if both years were limited. Oh, okay. Okay. I see what you say. Let's just go out and back in so we have a clean page. So, Mr. Dehofer, I think then what you were referring to, that makes sense, is if this was also limited to 0. Okay, let's just have a look at your question again. Where was your question? Why are we losing students? Is our time over? 8, 9:30. Yes, it is. Our time is over. I'm so sorry. I didn't realize that. I see some students are leaving. Okay, I'm sorry about that. I'll have a look at the chats that you have over here and see if I can't answer that on the discussion board. Oh, that was so much fun. I wanted to tell. I had so many other pictures and things to tell you about. We'll see if we maybe don't have a chance to do that tomorrow. Okay, but keep well. This was so much fun. We should actually try and have lectures for 3 hours instead of just 1.5. Yeah, go and what do you have next? Auditing. Auditing is always fun. So go and enjoy your other lectures. Okay, so I'll stop the recording, but I will stay around for a minute or two if there are any other issues.